All right, we are live. Welcome everyone to the MMT Macro Trader live stream, and it looks like we're live. So with that being said, welcome aboard. And if you are here, make sure you say hi in chat. Lets me know that everything is working the way that it should be. Hello, Odd Rogan. Welcome. Wild day today, to say the least, in the markets. I do have a bit of a lineup that I want to talk about today. We'll talk about the markets. I have some thoughts on what happened today. Seemed a bit inevitable that we'd end up seeing a drop, but I don't think this is the end of the story yet. So we will talk that. Markets. Let's see, other things I want to talk about. I had some threads that I laid out on Twitter over the last week, and they had some good engagement, mainly regarding inflation, the topic of last week's live stream. So we will talk inflation again this live stream as well. I also have some stuff that I want to discuss just regarding MMT and markets as a whole, start to lay out that argument. I'll also have some Twitter threads that I'll put out in the coming days, coming weeks as well, regarding kind of the thoughts on MMT and how it interplays with markets. So if you're not following me on Twitter, make sure you do that. Link in the description below. I mean, it was transitory until the Fed decided to go on a rate hike cycle. The inflation will go away at some point. Maybe it won't. Maybe it will be quite a while. I think there are a lot of policy errors that are certainly compounding the inflation situation that we're seeing. Let's see. What else? I'm just waiting for people to arrive. If you are here and you are arriving, make sure you hit that thumbs up button as well. Really helps the YouTube algorithm push the live stream. It would be much appreciated. Also, if you are new here, make sure you hit subscribe and turn that notification bell on as well. Where to begin? The other thing too, if you have any questions along the way, feel free to fire them off. I will gladly divert course and chat for a while on anything that comes up. So by all means, let me know as well. I'm noticing on the screen I'm about to share, I have something I need to fix. So give me just a minute to do that. All right, where are we going to begin tonight? Let's just start with markets. We had a precipitous collapse, to say the least, as this afternoon played out after the FOMC. Let me actually pull up my S&P 500 chart here, and we can use that as kind of a discussion point. Let's see, we'll go the Chrome tab. Hopefully you can see that. Yep. Okay. S&P 500, big collapse after kind of an initial, what looked like to be maybe a little escape, but not much of a rally. Ultimately ended up collapse. I think we're down 2.5% by the end of the night. As it stands right now, I kind of anticipate, actually give me one more second here. Pull this screen out. As it stands, let me make sure you guys are still seeing the right screen. Yep, okay. As it stands, I think this kind of makes sense in terms of what's going on overall. Throughout the night, throughout the live stream, I'll make kind of the argument that a lot of what we saw today was hedging dynamics that are playing out. And I think what's likely going to happen is we're going to see the continued kind of selling maybe through tomorrow, maybe even through the end of the week, ultimately give way to a rise. That's kind of where I think we're headed. But I really think the selling came from the hedging dynamics. And by that, I mean, there were a lot of puts that were opened up prior to today's FOMC leading up. I mean, really, there have been a lot of puts being opened up for quite some time, and a big lack of calls to offset that. And we've been in a really negative gamma rut. Today is just kind of a common day when, not a common day in terms of what the return was, but a common play in the sense that we had large selling happen after a major event as the hedging dynamics play out. So I'll kind of lay that argument out. And I do think what is likely happening is this is some sort of, if you're an Elliott waver, from an Elliott wave perspective, maybe some sort of leading diagonal that played out starting at those October 13 lows when we hit 3,500. Obviously, the leading diagonal allows for the overlap, and we're now breaking down from that diagonal wedge. I'd be looking at about 3,700. I think you could make the case that 3,650 as well would be a reasonable spot to start to find support. If this is a leading diagonal, then that collapse would be a wave too. So that's what I'm looking at right now for the S&P. We'll see how it ends up playing out. One of the things I'm going to touch on later is some of the models that I've used, that I develop, have hated this market, continue to hate this market, and as it stands are not changing yet. But I do think they're maybe possibly, although I've been saying this for a few weeks now and I haven't seen it happen yet, maybe on the verge of changing, in part because of where fiscal flows are at. So we'll dive into some of the stuff that I do every day over my Patreon page and give you a little bit of preview there and give you my thoughts in terms of where markets are heading. Either way, from kind of my Elliott technical eye, if you will, 3,700 is going to be kind of the first spot where I might expect some support, just being the 50% retrace that entire move up, and then possibly that 61.8% retrace at 3,650. Remember those numbers too, because that'll make more sense when we're a little later on down the discussion of the live stream in terms of why there might end up being support there and why those align well with some of the dynamics that are happening. So today's sell-off didn't seem too unlikely, but my guess is it might be short-lived. I'm trying to remember what FOMC meeting it was. I think it was the one maybe in June. Could be wrong, but I think one of them we had a big sell-off immediately following the FOMC announcement, very similar to today, like a very short pop and then ultimately a drop. And then I think the next day or the day after, we ended up seeing a rally after that. If you remember which event I was talking about, let me know in the chat. If you remember that when that played out. But either way, my hunch is that's how it plays out. But again, I trade my models. My models right now told me to stay on the side. They've told me to stay on the sideline for quite a while. So, I mean, that is, I'll trust what they're saying at this point. I built them just for that. But my instincts tell me we might not end up making a new low relative to the 3,500 low. All right, we're starting to get a few more people show up. If you are showing up right now, make sure you hit that like button, and it really helps out the YouTube algorithm. And, you know, it's a nice favor. Hit the like button. Tonight, like I said at the outset, we will talk the market crash today. We will also talk follow up on MMT and inflation. I put out a few Twitter threads that got some really good engagement, so we'll follow up on that. Some of the questions that I will answer is, one of the big questions that came back out of all that is, what's the impact of the interest payment that's happening from higher rates? I'll talk about that. I think I have the right. What's up, Adam? Thanks for saying hi. I appreciate it. Yeah, and if you are here, say hi in the chat. I would appreciate it. If you're so inclined. If you don't want to say hi, no worries. Let's see. What's the impact going to be of the interest payment? I think I have the right take on that. At least I think I have a view that no one else is really grasping onto. I've seen Warren Mosler hint at it, and I think he's right. So we'll talk about what the impact is going to be of the interest payments, and then some of the kind of like disagreement out of the threads that I had. We'll talk about that as well. Some of the feedback in terms of like low rates causing malinvestment. Low rates are really what lead to inflation. And I'll share some thoughts. on that. Michael, welcome. Thanks for saying hi. So we'll go over that, and then depending on how the live stream's going, I do have stuff set up tonight to kind of start building out really the next phase of some of the stuff I want to start tweeting about, and just kind of the progression of these live streams as a whole to talk kind of some base case MMT as it correlates with markets. I personally, I mean, that's where I really get excited. I personally think it's some of the most mind-blowing stuff when you start to see this piece together. when I started learning about MMT, and I actually looked up the first video that I watched, it was Bob Murphy and Warren Mosler debating MMT. It was 9 years ago now, which is quite incredible that it's been that long. But I remember, I think I watched it not too much after it came out. I was a big Austrian economic guy, and I'd been following Bob Murphy for a while. I found just everything about him just kind of intriguing, good delivery, made sense. And this debate showed up where he was debating this guy named Warren Mosler on this concept of MMT. I had no clue what MMT was. I think it was in the name of the debate. If you look it up on YouTube, you can find the debate itself. It's 2 hours long. It's really good. And I usually watch that sort of stuff in the morning when I was at the gym. So I mean, here I am. I used to get there at about 6 a.m. Do my warm up. Usually start in the sauna for 10 minutes. Head on to the elliptical or something to get loosened up. And I was on the elliptical for 2 straight hours watching this debate, or like an hour and a half, watched it at 1.5%. I mean, I was absolutely captivated. What I was trying to do with kind of Austrian economics is build really kind of a macro model. I mean, I figured there had to be some sort of almost scientific conclusions you can draw or come to if you model kind of the Austrian theory correctly, right? I mean, eventually you should be able to create a hypothesis based on a model and then look at the data and have the data either confirm or deny your hypothesis. It seemed to make sense to me at the time that would be an approach. That it was a great debate. Michael, the entire time, to summarize the debate, if you haven't seen it, it's Warren Mosler saying this is how it actually happens, and it's Bob Murphy saying, yep, that's how it happens, but in some magic world, it could end up differently. Entire debate that entire time, everything clicked when I was watching it. So the whole thing clicks. I head into the office, probably didn't do much work that day, probably started piecing this stuff together. Lo and behold, over the next 6 months, as all the pieces fell into place, I started to understand the whole MMT model. And that's exactly how it played out. I started to understand the entire model, and then you could really start to kind of test the MMT hypothesis. I mean, and that's at every corner for what it is that I was attempting to do with MMT. Constantly it was confirmed by the data. It was confirmed by the data. It was confirmed by the data. It was never one of the things that I absolutely hate to ever rely on, and I hate to hear, and it hurts me to hear, is when anyone says, well, it would be this way if it wasn't for the crowd going against knowing what's right or something like that, right? And that's always the answer from the other side is it's really just actors who are going against their best interest or something like that, where there's an actual realistic cause and effect that is happening, and then there's everyone just going in the wrong direction. I always hated that, right? In other words, well, why isn't, if you say that low interest rates are going to cause inflation, why isn't that happening? And the answer isn't some sort of concrete, either mathematical example or some sort of model that you can prove as to why this isn't happening. If it's really just, well, the behavior of people aren't doing what we think they should be doing based on what our models are saying. In other words, they're just, people are just stupid, which, I mean, could be the case. But that's just a bad answer. And if you can actually say, no, the reason interest rates are not causing inflation is because you have the mechanism of monetary policy all backwards. In fact, low interest rates should cause low inflation. Here's why. And you can then point to a correlation. To me, that's far more compelling and something that I can build on. So that is what compelled me with MMT. And like I said, I have a discussion at the end of the live stream, after we go through some of the stuff that I want to get out of the gate, at least market discussion out of the way. So we'll talk that at the end. Let's see. Let's start with digging a little deeper in terms of what's going on with the market dynamic. And I'm going to tie this in with a little plug real quick for my Patreon page over at patreon.com/MMT macro trader. 2 things that I want to say. One, what I'm going to do is actually pull up one of the things that I post daily. It's my daily dashboard, and we'll take a look at the daily dashboard in terms of what we're seeing today, in terms of the response of the market today, why I continue to be on the sidelines and just not taking part in the current rally, even though I kind of thought it was coming up. I'll give you a full rundown of exactly, kind of why I thought things would be happening the way that they have played out. So I will go over that. And again, this is going to come from the Patreon page over at patreon.com/MMT macro trader. And then again, just to put a quick plug in for that page for the month of November. I've never done this before. I've always had a few questions. I've always had, one, are you ever going to offer a lower priced tier? And then are you ever going to offer, do you offer any sort of like preview or anything? I've always thought the value's there. And if you want it, sign up for it. But for the month of November, I've been convinced to give a promotional rate out, and I'll do it for the month of November, $25. And here's the thing, I've always done this. If you lock in at $25, it's yours forever at that price as long as you're a member. So if this is something you've ever been interested in before, check that out, MMT Macro Trader. What do you get if you sign up? Well, that's what I'll show you a little preview of today, and I'll kind of break down how it is that I use the data that I have. Give me a minute to pull up my data dashboard. And this is what I post. This is at least the daily dashboard. I also do a weekly kind of big macro update, also a weekly Elliott wave update as well. But this is today's daily dashboard. I have my two main predictive models that I built. They're built on a Bayesian framework. If you're familiar with Bayesian statistics, Bayesian probability relative to like a frequentist approach, that is what the Bayes models are. The MMT macro model is kind of a buildup of all the main macro drivers that I've identified that correlate with, and it's really the basis, the MMT basis, if you will, right? Fiscal flows, bank flows, all the heterodox MMT stuff built into a model that essentially measures where the market is at. Green, obviously can't see. Back in the day, a long time ago, it used to be very green. We don't have much green anymore. It's been a very red model. It's on a scale of 1 to 4. It's effectively a quartile prediction model. We've been in the red for quite some time. That is the MMT macro model, and then the vol shift. So the MMT macro model is a directional model, right? It's predicting the direction of the market. The vol shift model is not a directional predictor, but instead kind of a variance or a volatility predictor. Purple, or the lowest rank, is expecting the highest price variance day to day or highest volatility day to day, and as you move towards blue, that's predicting low price variance, right? So compressed market versus a high volatility market. And as you can see, an example of kind of how this plays out, back in the August run-up, we saw the shift, which is why I call it the vol shift. We saw the shift from a rank 1 into a rank 2, and then ultimately into rank 3, kind of expressing that, okay, we're in kind of at the very least, given what we've seen on the macro model, a bear market rally here. And then as we started at the top, we got the rank 4, which means the lowest volatility. And then what we look for is the shift as we drop from 4 to 3 to 2 is kind of an indication that volatility might be kicking back in, again, based on where we are at with the macro model. So those are kind of the two main models that I use day to day to trade with. Again, they take in all the main macro data that at least I piece together. That actually correlates, and we'll show again later on in the live stream why some of that correlates. What I want to talk about right now, though, really is the gamma picture. I've gone into detail in the past. I won't go over too much detail on exactly how gamma moves the market, but suffice to say, we've had this really strong positive gamma build at 3,900 and 3,950 above market price for quite some time now. And we're really starting to see the negative gamma build at each S&P strike start to shrink. But there was this ever-present build of about negative 2 billion at the 3,600 level. It was sticky. It wasn't going away. We ultimately saw today price hit right up around, I think we topped close to 39.50, but we're never able to get through. So remember, as we're at essentially a 0 to slightly positive gamma build, as you push higher to net builds above price, such as the 39.50, that ends up becoming a kind of a resistance at that price level. And as you get close to that price level, you will oftentimes get rejection because market makers are forced to sell once you get to that level. And then in this instance, because we had such a strong pull beneath beneath the current price, hedging takes place as the selling comes in, right? So when you start to sell, if there's a large negative gamma bill below price, dealers have to sell because they're short those options. They have to sell to hedge price going down, and that's exactly what we ended up seeing, right? We ended up seeing price hit about right around that, I think it was 39.50, rejection at that price. There ended up being a barrier out there. I mean, had we gotten through, we'd likely be off to the races right now. 4,000 would be absolutely within range, but the dynamics played out where we ultimately we got rejected at 39.50, and then the selling absolutely took over as the hedging dynamics played out, as market makers who have positional risk at the lower strikes had to start selling, and we ended up seeing that. And this is why, too, I think I said that 3,700 zone is where I would expect to start to find support, because once we get down to that level at 3,700, the dynamic that played out today is going to flip in reverse. We're going to get to 3,700. The selling that brought us to that level is going to give way, and we're going to start to see kind of a pinning effect. And my guess is somewhere between 3,700 and 3,600 is likely where we would end up finding support for this kind of sell-off, and then kind of allow the opportunity to rinse and repeat for the market to kind of do its next thing. So that's kind of why I'm thinking that with those Fibonacci targets lining up around that area, that's probably where we're going to hit, possibly find support, and then all you got to do at that point is just assess the macro condition to see, does it make sense to buy here, use the other tools that are available, the other macro tools that are available, that again I make available over at the MMT Macro Trader Patreon page, to see if this is a reasonable buy spot, especially if you're a swing trader. If you're a flow trader, which is I'm a little bit more to that. I'm usually kind of somewhere between buy and hold and wait for the flows. I trade mainly off the MMT macro model. In that case, you're just going to wait for this thing to start picking up, and its rank, in other words, no longer showing red, starting to move into green territory on the MMT macro model. The other thing, too, that you want to look for, some of the other signals, they can give you a bit of a buy signal, especially if you're a swing trader, is going to be the GEX-DIX signal. I'll put together a more comprehensive video to go over this, but if you're familiar with the squeeze metrics data, it's a pretty good data set. Effectively, when you get below the 5% in terms of the recent average of the GEX-DIX signal, that's a pretty good buy signal. When you get above, that's a pretty good sell signal in terms of potential peak. Obviously, we got multiple buy signals through October. Ultimately, got a bit of a boost there off that October 12th signal, and obviously we're giving way now. The GEX-DIX signal has not performed as well as it has in the past. I've gone over some reasons in the past why I think the dark pool has been a little bit higher than normal, but nevertheless, that's kind of where we're at. So for me, I'd be waiting for a nice push lower, probably below about -2 million on the GEX-DIX if I'm a swing trader to look to buy on the buy side. Mean reversion, again, this is a dynamic mean reversion, so it's looking at the last 2 years of data and determining the 95 and 5th percentile of relative returns to the mean, or relative price to the mean, and saying, once we get above the 95th percentile, usually above the mean, below the 5th percentile, that's going to be obviously a buy signal. In other words, you don't want to be buying high, selling low. You want to go in reverse. So again, we're looking for an entry if you're looking to enter. If you're looking to enter, you want to enter when the market is low relative to its recent trend. Am I aware of velocity and infinite banking? I mean, if you're talking velocity of money, yes. I've never heard of infinite banking though. So if you have a link or a brief explanation, maybe I could figure it out. Finally, in terms of, I'll take a look. I'll you've intrigued me. I will Google it when we're when we're done with the live stream. And then finally on the daily dashboard, it's just the fiscal flows, which is really kind of the key component to all of this. And they continue to push. This is why I think eventually we'll get a turnaround here, because it's not like fiscal flows have absolutely collapsed over the last 2 months. I mean, they did back during the summer, but they're starting to pick up. So yeah. My big thing that I wanted to show with this is why I kind of thought we would see a bit of a rejection today in terms of price, and where it is that I think ultimately price will be heading into the future. I didn't watch the presser, but my understanding is that Jay Powell, this is the FOMC, my understanding is that Jay Powell kind of tried to be both a hawk and a dove at the same time, thus my slightly creepy thumbnail for this video. I gotta admit that when I watch any kind of mainstream economists, Keynesian economists, it just feels like I'm reading Ptolemy explain how to land a rocket on Mars or something like that. Like I'm sitting there scratching my head. It's been a long time since I took an economics class that taught mainstream Keynesian economics, and it is I'm just scratching my head to try and piece together what it is that they're actually trying to say in terms of policy. Because in my mind, when they talk about being hawkish or dovish, when they talk about trying to create tight conditions or loose conditions, I it's hard for me to forget what MMT actually teaches and get in their mind, and then also play kind of the next step of what it is they're thinking based on kind of the theory that they're putting forth. So I just usually don't watch, but apparently he had both a very hawkish and dovish tone at the exact same time, and that led to some wild swings during the press conference. Infinite banking is when you take out a life insurance policy and you borrow money from your life insurance to lower expenses on the loan. Velocity leveraging credit to pay loans faster. Okay. As I'm reading that, I don't know if I'm piecing together exactly what it's saying. Let's see. Infinite banking is when you. I'd have to think it through. I'd have to write it all down. Yeah, I'll write it down and I'll think it through and look it up and see. Borrow money from your life insurance policy to lower expenses on the loans. Yeah, I'll think it through. I don't know if you can do something like that. All right. We'll look into that in a while. Let's see. Next up on the stream is look up Denzel Napoleon Rodriguez. All right. I will check it out. Next up on the stream, let's see. Let's do a follow-up on the inflation discussion. Again, if you're on Twitter and you're following me on Twitter, I posted a few tweets, a few threads regarding inflation, and had some really good feedback. I think the biggest question that came up is what's going to happen with the interest payments that are heading into the financial sector from the higher interest payments, right? So what's actually going to happen there? And a lot of people are worried. I'm going to pull up my different chart here. I think a lot of people are focused on what kind of the nominal value is and the nominal effect of the interest payment is relative to all the money that's already in the savings, or the net savings, right? And I think what's most important when it comes to it is not even so much the nominal value, although that is going to be important. What's really important is what the impact of that is on the financial sector as a whole. So let's go back. Let's just take a step back, kind of reset the discussion here, right? The idea is higher interest rates are going to dissuade investment because it's going to be more expensive to invest, and that will lead to layoffs, which will, business layoffs. They're not gonna get loans. That's going to lead to business layoffs, and that will ultimately decrease demand because people aren't going to have jobs, regardless of the social impact of such a policy, which seems absolutely terrible. Besides the social impact, which I'm kind of, I hate to say it, less interested about right now. The question is, of course, what is that actually how the dynamics play out, right? Even if we agreed that was the social impact of that was ethical, is that how things are actually going to play out? And the counter to that, the kind of MMT counter to that, of course, and this is what I laid out, is that one, interest rates are going to increase the term structure prices, which means that's going to raise prices into the future, which leads to a push higher in the velocity of money because it forces money in the system to turn around faster because new loans are going to be generated at higher prices. And that is the entire mechanism, the dominoes, one after the next. Every price will raise higher. So there is that impact that occurs that pushes the velocity of money. We went over that. I showed the correlation there. And then the next, of course, is that at higher interest rates, there's just more interest being paid out. And that just means more net savings. Government spending is net savings, and that net savings ends up in the financial sector. And so, again, the question is what happens with that net savings. In and of itself, it's obviously not that big of a block compared to the rest of spending. But here is, and I pulled up what the interest payment is, and it's starting to accelerate. I mean, you can absolutely see it starting to accelerate, and this is, a quarter behind. Oh, no, it's not a quarter behind. But I mean, either way, this is only updated quarterly, and certainly every day this is only going to continue to accelerate. But the real thing you got to think about is the fact that banks own a ton of treasuries, reserves, other assets that bear interest, and that interest is tied directly to the higher interest rate, right? Let me look up here. Is it interest on bank reserves? I'm not seeing it. I'm forgetting the exact name, but I mean, I mean, banks are getting paid a lot of money on their reserves right now. They're going to get paid more, on their treasury portfolio. Why does this matter? It matters because when the banks make profit from their assets in the form of interest payments, that profit can obviously be divvied out to shareholders, but that profit can also become a cushier equity base. And there are obviously a handful of constraints to making new loans. One of them, of course, isn't the reserve requirement, but one of them is the overall capital structure of the bank. They have a reserve requirement that they have to meet. Not a reserve requirement. They do have a reserve requirement, but they do have an equity level that they have to meet in order to allow their balance sheet to what's up, Nicholas? Gold yet? Man, I made a gold video yesterday. You can see in that video what it is I think is going to take for gold to take off. So check that out if you haven't. Where was I? It's the profit from the equity payment or from the interest payment is going to end up as net equity on the bank's balance sheet, and that net equity is what's going to allow them to expand their balance sheet and stay within the capital requirement as a whole. And I think this is the thing that people are overlooking in this entire debate is it's not just the actual payment, the nominal amount of the payment on interest to the financial sector, which will be, the net savings. It's actually the fact that is padding the equity of the banks as profit, assuming they decide to keep it as equity and not paid out as profits, and will only allow them to continue to expand their balance sheet even more. What that brings me up to then, kind of the next point is, and kind of the next counter to the whole kind of higher rates cause inflation, is that that will lead to malinvestment of some sort, right? And or that, I'm sorry, that's not the next point. What I wanted to talk about is eventually how this leads into lower rates actually cause inflation. The next thing that is kind of worth thinking about is with regard to that impact. I'm sorry, I'm reading over my notes right now to try and get me back on track. I lost my track of thought here. Either way, just to summarize, I think the big point I was trying to make is, yeah, you are going to see net savings increase from the interest payments, but the biggie is going to be the banks allowing themselves to start to expand endogenously. And that's what I want to talk about. And then the thought is that eventually but eventually, the higher interest rate payments that everyone is going to have to pay will eventually slow down the economy, right? That will finally be the piece that slows down the economy. And quite a few years ago, I remember running across this, and maybe Steve Keen has updated this since. I know this video is quite old, over 10 years old now. And this is still before he built his Minsky software program. He was still working with a software program called QED, I believe it was called. And he laid out kind of the mathematics of why that's not necessarily the case, that higher interest rate, or just that interest payment is necessarily what will cause the contraction. Nicholas, I'll talk about how do they slow down food inflation in just a second. Which I think I did kind of reference in the Twitter thread. So if you haven't seen that yet, check that out real quick as a quick primer. But effectively, what Steve Keen lays out, and I think is just something you can only be aware of if you've built the system dynamics that he has with regards to how endogenous money creation works. But effectively, because of the velocity of money, because money cycles fast enough, and I think eventually he shows his little system. I tried to stop it right on that. Well, we'll see. Sorry, this is loading here. It's just going to suddenly play. Either way, what he shows is that the flow of money, if it's sufficiently fast enough, if it makes the loop in the you can't see my finger. If it makes the loop fast enough in the entire economy, that because the flow is fast enough, the actual interest payments can continue to be paid as long as the money makes it through the economy in the necessary amount of time. And my point is, as interest rates get pushed higher, right? And remember, we talked about the connection between interest rates and the velocity of money. Well, as interest rates get pushed higher, that also pushes the velocity of money higher, which means that the payment fulfillment time frame also gets pushed higher, and that allows stability to happen where people are still able to pay off their loans. So the theory that they're just not, if interest rates go high enough, it's going to slow down demand. Well, the only reason it would slow down demand is if they weren't getting enough profit to pay the next guy off in the loan chain. That would slow down demand, because then there would be an inevitable crunch in the system. But what Steve Keen points out is because mainstream economists mix stock and flows in the dynamics of the system, they don't understand that it is actually possible to find equilibrium in a kind of a pure banking system and not ultimately hit a crunch. So that's kind of the second piece to why, to kind of the rebuttal of high interest rates affecting the economy the way that they will. And I think without a doubt the kind of empirical data that we've seen over the last 30 years since we've really developed, since the U.S. really 30, I guess going 40 years now, 40 plus years since we've really developed the kind of post late 70s, 80s banking system, the modern financial banking system really has borne out the MMT heterodox understanding of banking and money. And I do think that it will, the sufficient mechanisms are in place to make it where we're not necessarily going to see a contraction in the banking system per se. But there is a way, and it's with the Eurodollar system that could end up causing that. So I will I'll probably hit on that in just a minute in terms of the live stream, in terms of how possibly I think there's a back end way for higher interest rates to slow things down. I really just don't know. I mean, how it will interact. But if you're curious, credit money, how it works, it's a 3-part series. I think this is really the best series Steve Keen did, and just laying out kind of the base case for his whole argument. So this is worth watching, even though it's old. This is probably a good place to start watching, because he really covers things, I think, in the most amount of detail and succinctly as possible. Moving on in terms of the next part of the discussion, and again, guys, if you are here, make sure you hit that thumbs up button as well. It really helps the algorithm out. And if you have any questions, feel free to fire away. If you need anything clarified, send it my way, and I'll be happy to answer. The next thing too is now going to kind of the low interest rate side, right? That the low interest rate is really what's going to cause inflation. People are going to be more. There's going to be more of a desire to get loans at the low interest rate. And again, the inverse of everything that I just said is true, right? It's going to slow down. It's going to slow down the velocity of money. The need to necessarily get the new loans is not going to be there. But most importantly, I think the argument goes something to the extent of male investment. The low interest rate is going to lead to some sort of male investment, or some sort of over-investment because money is cheap or whatever. And I would argue it's all relative to what they think the profit is going to, well, not even the profit. I think it's all relative to what they think the cash flow is going to be, right? I think that's the most important factor. If you think you can get certain cash flow out of any loan to pay off the loan, then you're going to do it. If you're a business, and the reason I have the Fed funds effective rate up here, and I'm going to zoom on in to really kind of the beginning of the modern banking system here, is just to point out that I would argue that the highest male investment period that we've ever had was heading into the dot-com bubble, and we had a relatively high or growing interest rate at that point. I was alive at that point. I was still relatively young. I was in my teenage years, but I do remember Pets.com, and I do remember Oracle having momentarily, I think, the highest valuation in the world. I do remember WorldCom and Enron, and was it Tyco? Was that the other one? I mean, all the other just complete scams all happening back then. And that was high interest rate relative to where we're at today. So, I mean, if low interest rates create malinvestment, then I don't, and you want to say high interest rates dissuade malinvestment, I don't see that empirically in the data. You'd have to convince me with some better correlation. I don't know how you'd weigh malinvestment versus quality investment, but I think there's malinvestment all the time, and I think there's quality investment all the time. I think it's really up to the competitiveness of bankers to either desire to make bad investments or bad loans or not. Next point I want to bring up is, if I remember correctly, from 2004 to 2007, it was not the best time period of quality investment. I think, again, we had a lot of malinvestment during that time frame. So again, I know this isn't kind of empirical data directly, direct correlation here, but certainly I don't think higher rates or lower rates necessarily are going to lead to malinvestment over higher rates. I think that people just bankers are just going to be willing to extend loans. Let's see, to get the profit that they need, or to hit the metrics that they need. And I think Hyman Minsky is absolutely right. I think there's a cycle from conservative loan creation to more risky loan creation, to kind of Ponzi loan creation, where banks eventually start to hand out money just to keep their balance sheet solvent. And I don't think that necessarily revolves slowly around the rate cycle per se. So I think the two major recessions that we had that were financial recessions, I think, were more coincidental to the rate, or maybe the Fed maybe more chasing what it is they're seeing than the Fed actually causing the contraction itself. But I guess it's kind of a discussion for another day. So there are those thoughts regarding kind of a follow-up to the Fed system. Let's see. Any questions? I'm going to hit kind of the next big point here, and we'll get rolling. So if there are any questions, send them out now. Here's where the fun's going to start, really. So if you've kept up this far, things are going to get a little technical. So bear with me. But this is where we're going to start having some fun. All right, let me pull up my base flow of funds model here and get my drawing board here as well. Here's what we're ultimately going to prove. Actually, let me show you what it is that I want to prove when we're all done. And along the way, I'll have some more discussion. A few points that are still hanging out there regarding inflation as well that I want to hit on. But again, flow of funds model up on the. I'm sorry. Let me actually hit on that first in terms of how are we going to slow down food inflation prices. I mean, at the very least, I will say stop the rate hike cycle, bring rates back down to as close to zero as possible. I don't think a zero interest rate policy is as possible in the U.S. Due to the way overnight banking works. But either way, get back to a zero rate or near zero rate policy. That would be a start. And the other thing, too, is start investing in domestic production of food. I mean, that would be certainly one way to deal with it. I don't pay too much attention, admittedly, to kind of trade discussions. So maybe there's trade policies or tariffs, something that's standing in the way between imports. But if there's ever anyone out there who wants dollars for food, I think the U.S. should have a policy to certainly encourage that. And if someone's willing to give up a real resource like food for a dollar bill that can be printed, I think that is something the U.S. should absolutely target. I also think there's kind of long-term real energy independence that needs to take place. I haven't researched it a ton, but and maybe I'm wrong on this, but I really think something like nuclear energy is a way to go. I think there are policies that we can put in place today that maybe might not bring down inflation tomorrow, but given the fact that the globalistic or the globalism system is always at a bit of, it'll be challenged. Even if it kind of survives this wave, it'll be challenged again. And I certainly think those in the West who have a worldview of, kind of liberalism in general, I think it would be worth their while to, and I'm not talking U.S. political liberalism, but I wouldn't be against localizing food production. Okay, at the county level, I do think there is something to say for, and I know the carbon footprint of kind of mass farms and everything like that is not the best, but it is a hell of an endeavor to farm, and to do it at the scale that the world needs to consume is a very difficult thing. And it really hasn't been until the end of the last century where we were able to feed everybody globally with the food that we make. And I don't have enough of an understanding to speak fully intelligently on it, but I know I don't want to become a farmer. I have nothing against farmers whatsoever, but I know I can't become a farmer, and I've seen models of kind of local farming, and it just seems like you need a lot of people farming to do local farming. But investment in local farming wouldn't be a bad thing per se. That could be a start on food inflation. Those are my thoughts. Maybe I'm wrong. I'm happy to be kind of proven wrong on that. I've no tie to my view, I guess. So feel free to shoot some things my way if you want to. Okay. flow of funds. What is it that we're going to prove here? Let me pull up what it is that I really want to prove. And I'm going to pull up my data dashboard here. So what I'm showing is the correlation between net fiscal flow. So this is government spending over a 90-day average. I get this from the daily treasury statement. And the 30-day forward S&P returns. So what is the S&P going to be 30 days down the line given the current fiscal flow average? Usually when you do charts like this, the correlation is zero, right? It is an even distribution of forward returns. This is the strongest correlation of any data point out there with forward returns. It is also something that has not been terribly tapped into by kind of the big market movers. It's hard to get in front of with a lot of money because, well, you need the new flows to get in front of it. So again, on the x-axis is the net fiscal flow. On the y-axis is the forward return for the S&P 500. Higher means more forward return on the y-axis. Further to the right means more fiscal flows. Very strong correlation. It's also worth pointing out that you have very low risk of big drawdowns when fiscal flows get higher, and as fiscal flows get lower, that's where the big risk of drawdowns begins to occur. Obviously, there's a strong pocket of just kind of normal distribution, but the big takeaway here is that large returns begin, and kind of steady, sustained returns begin with large fiscal flows, and drawdowns happen as fiscal flows drop off. This is where we're going to conclude, and we're going to find out why this all makes sense, right? And this is going to go back to kind of that discussion that I started off the live stream with regarding Warren Mosler and Bob Murphy and why everything clicked. Okay, so I'm going to kind of go through the steps that I went through now 9 years ago as I pieced this all together. And it literally was just okay, well, if this is the case, then I should see that happen, right? You know, there should be a cause and effect that's happening. You should be able to make some sort of hypothesis to what the data should look like. So let's start with, this is just kind of a basic flow of funds model, and it really represents the sectoral balance view of MMT, right? The idea is that the federal government, when it spends, that sends the money to this is 2 live streams in a row now that I've had my children head on outside mid live stream and start playing loudly. Give me 1 second. Give me 1 second to close the window. Hold on. I'm back. I'm back. Sorry about that. I've had 2 beautiful nights that I've been streaming on, and the kids have taken 2 at my office sits to my backyard, and the kids are out there banging away on the swing set. Yeah. If the real dad in me came out, I'd be screaming at them. But I know I'm on the live stream, so I can't. Damn kids, I can't do that. They gotta have fun. All right, flow of funds model. Federal government spends. That spending heads into households as savings. Let me make sure my mouse is showing up here. Heads into households as savings. That savings obviously just becomes private savings, and I think it's this green line right here that's showing that savings as deposits in the financial sector. Exactly the same thing happens with private companies. Again, the green line showing how those flows end up in the financial sector as well. And this is key. The financial sector, the savings that end up there as deposits, the financial sector needs for some of their equity, right? So some of that savings is going to become bank equity. The drain on this entire thing, of course, is going to be taxes. Thus it's in red. Obviously, both private companies and households are going to pay taxes. The other big thing with sectoral balances is that fiscal spending minus private sector savings minus any leakage that ends into the rest of the world better equals zero, right? That is just an accounting identity fact. And so that's kind of the essence of the fiscal of the kind of flow of funds model as it's represented in MMT. And one of the things as I kind of piece this model together that I really thought about is as the savings ends up into the financial sector, the question is, what is it looking like on the balance sheet when it gets, how do people save effectively? How do people save? And what is the impact of that heading into the financial sector? And that was really the first time where I'm like, well, look, I know how I save, right? I mean, I got a 401k and I know how my money ends up when it becomes savings, right? So in theory, right, if a small portion of my savings ends up as investment in companies, then I think there should be some sort of correlation between fiscal flows, right? The other thing is, even if I spend that money, right, then that should be someone else's savings, right? A company's savings or something like that. If I buy a cheeseburger at McDonald's or whatever, right, that becomes McDonald's savings. And they might invest it in some way, right? Now, obviously, they're not going to buy stock, but that's still at least a profit for them. And that would increase the price of McDonald's stock in theory, obviously. I mean, not one for one. Maybe I go to Burger King and McDonald's goes down instead. Maybe I don't eat fast food at all and I buy my groceries. Right. I mean, the point is some company's going to get a profit out of that. So start asking questions. If that's the case, then there should be some correlation, and of course, that is exactly what we end up seeing. The other kind of thought, and I'll try and tie this now into inflation, and by that that's what I mean. It's this correlation that we end up seeing right here, right? The other thought too, and this is, I think also overlooked, is, let me see, go back to this. Yeah, is what the bank is doing with that money when it ends up there, right? Because how do banks in the U.S. operate? Well, they operate. Yeah, glad you like it, man. I think it's helpful too. I think it makes things click. And again, the biggest takeaway in any of this, and I'm always, I know I probably come off as rude in some of the Twitter stuff, but especially when I respond back, but my sincere intent is to always be proven wrong if I can be proven wrong, because it's only going to help me understand this better. But the only way it'll sink into me if I am proven wrong is through like diagrams, is through models, and then give me data that makes sense based on the actual models. And then if it doesn't fit, don't give me the excuse that it's because human behavior just doesn't match up with reality right now, or whatever. Whatever the excuse is why the things didn't happen the way the Fed thought they should. So, I think it's really helpful as well. Let's see, financial sector. Okay. So what's going to happen with this money, right? Well, so if you're a bank, right, and you want to make a loan, if you want to be a bank, you have to get chartered, and then you also have to have certain capital requirements to get off the ground anyway. You need some sort of net equity, right? You're going to need someone to buy shares of your bank. You can buy them yourself, whatever. You're going to need someone to buy shares of your bank. And that's how you're then going to start your bank. And obviously you're going to make money as a bank by lending out loans, and you're going to, you're going to lend out those loans, and your profit's going to be the interest on those loans. Now, if you're in a zero rate environment, what you're going to do is you're going to charge people out the wazoo for fees and fines and everything just to bank. But if you're not, if you're in a high interest rate environment, what you're going to do is you're going to send out, you're going to create loans. And it's that banking dynamic that plays out that also feeds into what we would kind of call the money supply, but it's not the same as net savings, right? Because on the balance sheet there's going to be an offsetting liability with the new money. So let's do this. What I want to do, and I've done this before, but I'm going to tie it into inflation. And there's been some things that I'm thinking about too as of late. That I can see kind of a backdoor way where the Fed can create the slowdown they want. They don't even realize this is what's going to take place, but there's a backdoor way that the Fed can create a slowdown for what they want, based on higher interest rates. And again, I haven't heard anyone talk about it in this manner yet, so maybe it needs to be vetted a little bit more. So I am going to switch back over to this screen right now and try and find my drawing pen, and I put it in my pocket so I wouldn't forget it. And let's do this. I'll get my cursor over there. Hit F11. We're going to go full screen here. What we're going to do, and again, I some of the stuff becomes it can become a little, I don't know what the right adjective is here, pedantic. It can become a little high level, but it's worth understanding. I mean, it's really where the payoff is. It's really worth going through the balance sheet operations. I promise I'm not going to get overly technical here. I'm going to stay relatively high level, and hopefully we can understand this, and we can see why some of the assumptions that are being made right now are just not the right assumptions, and see this in balance sheet form, because I think it really sinks in. So let's go ahead and do this. Let me make sure. We're going to go pen. I think pen is what I want. All right, we're going to do some balance sheets here. Balance sheet. We got balance sheets. All right, so here's our little scenario. You want my home, and we're going to make this work. And we're going to show how this happens. All right. So you over here, and you have a problem, is that you have no money, and we like each other, but I don't trust you in it, because you could just give me an IOU, right? But I don't trust you that much for my home. Maybe my PlayStation, but not not my house, right? So my asset right now is my house, and like we said, can you see the stuff on top? You can't. Let me give me 1 second to enlarge this window here. There we go. All right. I have a house. You want the house, and again, I do promise this will tie back into some inflation discussions as well. So I have a house. You want the house. How are we going to get this done? Well, what we need to do is we need to get a bank involved here. So we're going to add the bank. What the bank is going to do, and this is what banking does, right? Notice too, there are no reserves in this system to begin with, right? We don't need reserves at this point. What we do need, I mean, technically this bank wouldn't get a charter if it didn't have equity to begin with. If it didn't have some sort of equity to begin with. But for now, that doesn't really matter at this point. Big thing is we don't actually need reserves at this point. So let's do this. Let me get my eraser. I made a little scratch there. You want the home. I've got the home. I want the money. How do we get this done? Well, this all happens at closing, actually. This is literally what the closing is doing, at least my understanding is. So what the bank is going to do is the bank is going to create a loan. Put a loan here. This is their assets. This is their liabilities. You have assets. You have liabilities. Assets, liabilities. They're going to create a loan, which is now an asset that they have. You're going to have to ultimately pay it back. This is now your liability. So we're going to put $100. I'm selling my house for $100 here. You're going to have a loan for $100. Now they're also going to have an offsetting liability that they're going to have to create, right, for $100, which is going to end up being my deposit. So I have a deposit, they have a deposit, you have a loan, they have an asset that's a loan, and ultimately I'm giving up the house. You have the house now. The house is yours. You have a mortgage. You have the mortgage loan for $100 now that you have to pay back, and this is actually going to be I don't know, whatever it's going to be, let's just say $110 that you're ultimately going to have to pay back, right? And what's going to end up happening is the bank is going to have $10 in equity left over when we finally pay back that loan, right? We just created this money endogenously. And I want you to think about this, right? I understand that that right now we're seeing a bit of a crunch in lending, but in home lending, right? But I can tell you from the data, the crunch started before the interest rate started going up, right? And I don't think there's necessarily a causal effect. Maybe there is, right? But eventually what will happen is if the market doesn't tighten, which again, we've went over reasons why it might not necessarily tighten, that inflation is going to lead to higher earnings and higher paychecks, right? I mean, you're going to have bigger paychecks, and then all of a sudden the cycle can start again, right? I mean, we're having a slowdown because we obviously did see a massive fiscal push that then contracted, but that's really, the income channel will settle and we'll rinse and repeat. And so once that happens, the only constraint here is just the desire for anyone to want to do business activity, right? And what's also important is the fact that the higher interest rate is going to force this payback cycle, right? Because eventually you're going to have some sort of income that's going to come in that's going to be able to pay off that loan. Well, the rate at which this income is going to come in is going to start to push faster because of the velocity of money increasing, because the velocity of money is tied to and is really a causal factor from the higher interest rate. So your income is going to go up and you're going to be able to repay this loan. And then before you know it, you're going to have more capacity to create new loans if that's what you want. Of course, this doesn't have to be, a person in a home. This can also be a business, because this system works endogenously. Here's where things get tricky though, right? Domestically, this is how things work, but we're going to move things over a little bit. Just keep in mind that these things are here. One of the things that our financial system has done is once these dollars get created, right? Let me go back to my pen tool, right? Once these, let's just say this bank has, at this point, they have whatever, it doesn't matter. We're going to add some zeros to the cash that they have. And eventually those interest payments become, also obviously on their balance sheet, right? They can do something now with the profit, right? And one of the things you'll see, and this can even be businesses as well, one of the things that they'll do with the investment money they have is they'll put that money in a Eurodollar, in the Eurodollar market. They'll loan that out in the Eurodollar market. So what they'll do is, this will be an offshore bank. We'll call it Eurobank. Doesn't have to be in Europe. The Eurodollar is just a name for the system that got set up years ago. So what's going to happen is they're going to go ahead and deposit that $1,000. I think the minimum Eurodollar deposit is like $500,000 to actually make the LIBOR rate. But the Eurodollar bank now has $1,000 deposit, which is your liability. Or I'm sorry, it's the deposit's their liability, but their asset is now the reserve, and that's we'll call it the bank's deposit, right? This is where things get fun. So I just talked about how domestically lending happens endogenously. The idea of loanable funds, the idea of the money multiplier, that doesn't actually happen in U.S. domestic charter banks. That money is created endogenously. If it's money being created in the bank of that nation that's chartered by that nation, it's an endogenous money creation, assuming it's not tied back in any way to some other asset at the central bank, such as it's gonna be really confusing, but the euro system actually is that way, not to be confused with the Eurodollar system, but the euro system itself is that way. So in this instance, though, we're talking about the Eurodollar, which is the separate deposit, bank deposit world. So what do these banks actually do with this? Well, they are not chartered. They don't have the right to create loans endogenously. Effectively, their regulatory framework is a money multiplier framework. They're actually going to loan out. They're going to loan out your deposit, the euro dollar deposit, to a company, right? So we'll call this XYZ Corp. Whoops. Right. And XYZ Corp needs to buy some machinery or something like that. So, they will then take a loan, let's just say of $5,000. They're going to have obviously they're going to have a liability as well of $5,000. And so the loan that they have, I was going to go buy some, suppliers or build a building. So we'll just, they have a building now. That is what their asset actually is. And what's going to happen now is you're going to get into just a classic, a classic reserve multiplier situation, right? They now have $5,000 of reserves that are being lent out, and they're having $5,000 worth of liabilities that are, that's the reserves that are being lent out, and then the asset is the loan itself. And so the Eurodollar system operates in something much closer to the loanable funds or money multiplier model that you would have learned in economics. And therefore, under that dynamic, higher interest rates can cause some of the problems that that kind of mainstream economics assume would happen. And so this is where I think we could see, and we did. I mean, this is really where the slowdown is coming from, right? I mean, you had kind of a perfect storm of Europe hitting an inflation wave. Europe's always more insensitive to inflation. In this model, in this model right here, inflation markets are going to be far more sensitive to inflation. I mean, that's why the Eurozone, every time there's even a hint of inflation, you start to see a slowdown, far more sensitive to inflation, far more sensitive to the rate cycle, is going to happen because you're actually operating under this a system much more akin to the money multiplier system. And one of the things I kind of mentioned quickly during the last live stream was the fact that let me see if I can pull it up. Was the fact that if you listen to people talk about this dynamic, the Eurodollar system dynamic, they'll point out how the Fed funds rate completely dislodged from the LIBOR rate. So the LIBOR rate's going to be I'm pulling it up right now. So the LIBOR rate's going to be the rate that gets paid in the Eurodollar market. You can see during the great financial crisis, the blue and orange bar is the Fed funds rate, where the Eurodollar future LIBOR rate is the green and red bar. And you can see the momentary collapse when we were hitting the absolute worst of it in 2008. Until the U.S. and the European Central Bank stepped in and said, "Yeah, we're gonna backstop this system." You were seeing calamity in that system, and the correlation between the Eurodollar and the Fed funds rate separate, and that's always why the Eurodollar system is going to offer a little bit more interest, because going back to that model, or going back to how the dynamics play out from the actual lending side of things. There is a lot more risk, right? I mean, you have, and the other thing too, you have no backstop, you have no buyer of last resort to buy crashing assets in the shadow banking system and the Eurodollar system. If those assets crash, there's no central bank to buy them. So, I mean, if you're someone who wants to get rid of the central bank, I would say, you could be in a rough spot knowing how banking dynamics work. So, all that being said, I know we've been going on for about an hour and a half now, hour and 15 minutes, but all that being said, I think a backdoor way for the slowdown that the Fed wants to happen could come through the rest of the world slowing so much that just eventually the demand side eventually hits the U.S. and the Fed just has to take their foot off the gas on the rate hikes. We'll have to wait and see. On the flip side, though, I mean, going back to give me a second. Going back to this whole dynamic, one of the things eventually what ends up happening. I mean, I've never been a global financial banker, but I do know one of the things that ends up happening is some of the assets they will need. It's still a lot of the capital requirements, the reserve requirements are very similar to that of what's happening in the U.S. So I know one of the things that they try and do is at least get interest-bearing assets with the reserves they have. So they're buying treasuries as well, right? And they're starting to see the inflow, and then we'll eventually start to see the inflow of those treasury payments into their net equity as well, right? So their assets are going to increase, their net equity is going to increase, and they're going to, if they are feeling the squeeze right now, the balance sheet squeeze right now, eventually they'll start to get the capital infusion as well because of those higher interest rates. And I think I don't know what to call it a concern, but I mean, we could see a world in which inflation stays relatively high and we continue to see growth. If we're able to stay stable enough for the Eurodollar system to remain stable without crashing, and those inflows start coming in to stabilize the current contraction we're seeing in growth and then allow for kind of the next business cycle to take off. So I think that is a realistic possibility as well. At this point, the dynamics are what they are. You're just going to have to follow the data to see if we get an indication of another cycle happening, credit expansion cycle. And that indication happens when we start to see the dollar index push higher, right? Because when these banks are coming up short in terms of dollars on their asset side, or their assets themselves are starting to devalue and they have to start paying off the loans, right? They're looking for dollars themselves, right? And that's why you see those dollar short squeezes, because these are euro dollars. They're fake, right? No one actually wants the euro dollar loan that got created when shit hits the fan. They want the dollars that are actually the real deal, that are tied back to the domestic U.S. banking system. So that's why you see those dollar short squeezes that occur. And that's why when we see the next wave down of the dollar, when we see the dollar stabilize and start to push lower, it's a pretty good indication that the global banking system is starting back up, that this whole process is starting back up again, and you're starting to see loans go out, because that means that's an indication that more dollars are being created. Suppressing the dollar, loans are going higher. There's more dollars in existence. It's a kind of a synthetic short on the dollar. Suppresses the dollar, process reverts course, shoots the dollar back higher, and the cycle repeats. So let's see. Those are my thoughts for tonight. I got some questions coming in. This is a fascinating idea about the relation to the Eurodollar market. It makes sense, similar to how Ray remarks about how developing countries suffered in the 80s with the Volcker hikes. I haven't studied the global impact of the 80s. I mean, I know they were having a hell of a time back then, like the developing world. It makes complete sense that inflation in the rest of the world absolutely runs amok, and why, like, EZU, let's see, I've brought this up before. Let's see. This is not what one, here you can just see the inverted dollar showing up, and the super high correlation between the inverted dollar and the Eurozone. I think what I wanted to show is WTI oil. I'm just going to go U.S. oil. I know that's as I say, there we go. I'll turn off the dollar, and you can just see the very strong correlation between higher input costs and get rid of these get rid of these red bars. I mean, you're going to see a very strong correlation, far stronger than that between between the Eurozone and in oil than you're going to see between that and the U.S. in part because of this inflation dynamic playing out. And I mean, it's the cycle that plays out. So I think that's the mechanism by which it all operates, and I think the data bears that out. So the question, this is just kind of me being frank and honest here. What I haven't figured out yet is when is there enough of kind of a global depression that it affects even the demand side of things in the U.S. to an extent where the demand falls off enough where you start to get kind of diminishing profits, right? And enough to really knock the U.S. economy down. That's the $1 million question right now. And maybe we're there, right? I mean, maybe we are actually seeing that play out exactly. I don't know, but my hunch is that we could see a kick higher in the business cycle in the coming future, caused by the new net savings from higher interest rates. So those higher, I mean, again, going back to the way banking works, right? You don't need a lot of capital to expand a lot, right? So I see, banks just as willing and ready to create new loans at any interest rate. So that is my thought for tonight in terms of, damn, you know what I just realized? I don't think I ever flipped this chart on. I'm sorry if I never flipped this chart on. This is the chart, the correlation between oil and the Eurozone ETF. I had on momentarily the dollar and ETF, strong correlation between the two. And then ultimately oil as well. And then really the big surges in oil leading to contraction in the Eurozone. That was the point I was trying to make. So that is, that is what I have for tonight's live stream. I will hang out for another 30 seconds here, say goodbye, all that sort of stuff. If there are any other questions, fire them away. Otherwise, I will leave with just a request to make sure you hit subscribe. If you haven't yet, turn that notification bell on as well. And then again, patreon.com/MMT macro trader. I'm going to pull that up real quick as well. I have the promo going through the month of November. Make sure when you do sign up that you obviously select the promotional price. And like I said, we'll run that through the end of November. Hearing nothing else, if there are no other questions, I think we are going to wrap things up here. So until next time, good trading, everyone, and we will see you then. Bye-bye.